Hi, everyone. This is Jackie Cooper, and I am with the GBA as the talk show host. I also have another talk show that this episode is actually going to be also featured on, and that's Crypto Mom 2. And both of those talk shows feature activities that are going on the blockchain. And I'm very excited to be part of this journey with everyone who's listening. And I definitely want to ask that you like and subscribe and share it out with others because the blockchain community is all about mentoring and sharing and bringing others along. And that's one of the things that I've realized even within the GBA group. It is one of education and community support. And so with that, I also just need to mention some of the disclaimers that we always have to say. This is not financial advice. There's not legal advice here. This is purely educational and entertainment from that perspective of media. So today I have a really special guest on. Paul is on, and he's going to introduce himself in a quick second. He's been involved with the blockchain world a lot longer than I have, and I admire his wisdom and his insight. And we're going to have a very interesting conversation because of the fact that he has seen so many trends and developments as the blockchain has grown and emerged. So, Paul, welcome. How are you doing today?
Good. Thank you for having me, Jackie. I'm looking forward to this conversation.
Yeah, I am too, because we had a really interesting conversation offline, and so now we get to record it. Um, so why don't you go ahead and introduce yourself a little bit? I feel like I don't always do service to people when I try to introduce because I leave out certain things that I think are really important. So why don't you go ahead and introduce, and then we'll kind of take a dive into what we're going to be talking about.
Okay. I'm Paul Dowding. I'm co-founder and head of design for a fintech startup called L4S Core. We've developed a layer one DLT protocol, and we're now working through proof of concepts with our first clients, and we hope to go into production licensing this year. The venture spun out of a boutique consultancy from members of our board. We were mostly part of the boutique consultancy, which in the process was being sold, and the chairman was leaving that behind, but came in as chairman of our venture. We had developed the IP because we were looking at blockchain around about 2015. My background is primarily in operations, product management, and then innovation and strategy, but primarily around the infrastructure of the financial industry, not necessarily the front end trading, but supporting what happens after the trade is executed. And when we looked at the blockchains, we saw the huge potential that was there, why everyone was excited about this technology, and certainly some of the aspects of the crypto world. But we looked at it and saw that they tend to be customized, they're in their own walled gardens, they had performance issues, there's functionality missing in terms of like future data transactions, double entry accounting and payable receivables, being able to finance transactions. So originally we thought we'd be helping people solve those problems. But as the industry got many different solutions out there and there's a lot of distractions going on, we ended up sort of looking at the challenges we saw to fix the solutions and ended up designing Tapestry X to meet those. And then we formed the venture to fund a demo and then ultimately production software. And we're now beginning to hope to get traction with our first clients. So that's our story. I've been, coming from the infrastructure side, I've been involved in the industry. So I saw the birth of Ethereum and R3 and Hyperledger. I've seen all the other protocols around the public blockchains as well as the private permissioned, and I can talk to some of that with the work we're doing in GBA. And we've seen the evolution of the crypto and DeFi space. And there's this sort of tension between the TradFi, traditional banking and finance, that's trying to look at this new technology, and the DeFi crypto worlds, which are operating in their own sort of worlds and looking to either subsume or take over TradFi. So there's some interesting dynamics going on. And being part of the GBA has definitely, beyond, promoting ourselves, but more importantly, we've been able to contribute and learn back from the community.
You mentioned some interesting concepts. I'm very one thing that it popped into my mind while you were talking. I'm interested in finding out how was the name tapestry decided? Because, for me, the idea of tapestry is where things are woven together.
Yeah.
And when you think about what the blockchain is and also the community, it's a very appropriate word, but why was it chosen?
It was funny enough, and I can't give away all our secret sauce, but the if you think about one of the challenges with the blockchain is that it's usually a one-dimensional linkage,
Yeah,
and
yes,
so there's a single point of attack. There are other solutions out which are called directed acyclic graphs, where you can point to different transactions, and they're somewhat of an unstructured pattern. So they may differ from that in many ways. Um, but we believe we're the only DLT or blockchain solution that actually incorporates double entry accounting, and therefore effectively we're doing asset lot accounting at the front door. And the point being is that without again going into some of the detail, each asset lot effectively has 6 independent hash link chains overlapping. So when we exactly what you just said was, I didn't pay you to say it, but we saw that it was a woven pattern. And
yeah.
so what was the way of representing that? Unfortunately, there's a lot of things out there called Tapestry, but not any called Tapestry X. So I know X seems to be a popular thing to end it, but so we go between Tapestry X or Tapestry X. But because we've got that overlapping pattern, if you try to corrupt one layer, you have to interfere with six hash links. If you go to a layer 2 layers down, you're interfering with 36 hash links. So while there's key thing I learned in banking operations, which is important for anybody in this industry to recognize, there's no such thing as an incorruptible process. It's often said blockchains are immutable. They're really not. They're mutable, but they're corrupt evident because it's a very complex string of mathematical links. If someone tried to change it, it becomes obvious that it's been corrupted. But if someone can corrupt, a third or a majority, depending on your protocol, of the links, you can actually corrupt a blockchain. What you do in operations is make the corruption extremely hard to do and very hard to spot. So that's part of what we've done. But we use a combination of the blockchain techniques, operational controls, and the accounting to make it extremely hard for someone to try and corrupt it without it being spotted.
So, yeah, while you were talking and you were mentioning the 6 different layers, that occurred to me, that it would be very difficult, if you kind of attacked one side of it, there's all these others that would catch it.
Yeah.
So that makes it a little bit safer by using what you're
Yeah.
creating
Yep.
from the information side. It's for those that are new to the blockchain, again, you think of it like Legos. One block communicates to another block, communicates to another block. And so if you, as you mentioned, if you're kind of tangling with one of the blocks, then the next block is not going to recognize it. But
Yep.
you still have to have something in place. Otherwise, I guess that brings me to another. What about these forks that are going on? How does that, that's a whole
Yeah.
other area, but does that
Yeah.
require more additional security because of the fact that all of a sudden you have a fork?
Yeah, the challenge, and this is where there's a debate between public blockchains and open source and permissioned or private blockchains, because a public blockchain is effectively open source and free.
Yeah, yeah.
I could take a copy of the Bitcoin protocol and create, pull Bitcoin. Now no one will show up, but it still will be there. But the but the most people don't realize there's actually 9 since the original Bitcoin. There's at least 9 different spin-offs, forks of Bitcoin. Everyone knows when the Ethereum had the famous DAO hack. There's now Ethereum Classic and Ethereum, but there's also I'm trying to think what the status of it is. But Ethereum Classic was the original with containing the DAO hack. The Ethereum went forward with the sort of Wayback Machine where they changed all the records. But since they've gone to proof of stake, I believe there's a group that may have maintained the other Ethereum. But the point is that with a public blockchain, you can make a copy. It's not such a security issue But the thing I try to say to people, when you're recording something on a public blockchain, it's there. And if it forks, like if you had the original Bitcoin, I said there's 9 different types of Bitcoin out there: Bitcoin Cash, Bitcoin Gold, and so if you had one of the original Bitcoins, you've actually got 9 now assets under your original key. So the problem is if you've got a contract that's written to Ethereum and it forks again, there's actually 2 versions of your contract. Now you can claim that this one's the real one, but there's another one out there. So if anyone gets your keys, can they represent that asset as their own? Could they create a full sense of collateral or whatever? So there are issues around forking that haven't really seen in great scale in the public blockchains, but it's something that's out there that people have to think about. And that's where, when you're in the regulated or fiduciary worlds, you've got to be very considerate of those things, because you can't just say to your client, oh, you've got an extra asset out there, but don't worry, we're never going to touch it and no one will ever be able to do anything with it.
So that brings up some other questions, because my mind is spinning on all this right now. For those, again, that are new to the cryptocurrency world, you can think of cryptocurrency and Bitcoin as a currency, but blockchain also can be used for information exchange separate from that. But think about fiat. A lot of times you have a dollar issued, a quarter or a penny, and maybe the complexion of the penny might not have as much copper in it as it did, at one point. So when you're talking about the fact that there might be 9 types of Bitcoin, if I have a wallet and I have Bitcoin in there, and it's one of the originals, does it, I guess my question, because again, I'm still learning too, and I decide to claim that, it's still claimed, but it's going to be the original. It will be paid in the existing Bitcoin protocol that is now.
Yeah, it'll only have the value. Like Bitcoin has a larger value than any of the other Bitcoins because it's got
Yeah.
the most activity on it. So the other Bitcoins are worth a lot less. But because they're originally recorded under your original public key, you could go back and get them. The challenge is your wallet doesn't necessarily reflect it, because again, a wallet isn't necessarily a reconciled bank account. It's just saying, go to this protocol and tell me what's registered under this key. It's doing more of a search function. But if it doesn't know to go to these other protocols and find them, you wouldn't know you own them. But it's an interesting.
It is a very interesting conversation.
I tend to deal in the regulated institutional world where we're, our solution. The key thing that we were able to do was, outside of trying to make it more secure, was we made it generic and agnostic, so that it could interpret any life cycle. And now we've got interest from things like supply chain, records management, even voting, where the asset is not necessarily a financial asset or a currency. It's just a record. And think about supply chain. All the goods are assets. Even the equipment that moves the goods or the equipment that processes the goods are assets. So they can all be tracked. And so it's a very interesting world. So we made it agnostic. The real key thing with our protocol was that we found a way to synchronize, because most processes send the transactions to a virtual middle, and they're mined in Bitcoin, a competition, or they're voted upon, or they're sort of rotating elected or selected leaders that validate them. Well, the problem is that's where it introduces capacity constraints, latency, and scalability issues until they're passed back to the owners. In our case, we're able to synchronize the data across the network based on the transactions alone. So we've effectively got synchronization without mining consensus or independent validators. So that makes us scalable, real time, and very high capacity. The fact that we have double entry accounting also allows us, as I said, a blockchain is timestamped transfers of ownership. So if you were given Bitcoin 2 years ago, the only record is that block 2 years old.
2 years ago,
so
right.
You have to keep the whole ledger in active memory until you spend it. That's ultimately going to be unsustainable, even if you create Merkle trees, as they're trying to do in Ethereum. What we did is we did it the old-fashioned way, which is to say you have starting balances, transactions, and ending balances, and that allows you to archive the transactions and carry forward the balances. And therefore, you still got a continuous linked record, but your active memory is just today's balances, today's transactions. But now, because we've got transacting periods and double entry accounting, I can record future dated payable receivables. So if you look at the problems with the DeFi protocols, is they're really not lending these assets. They're really just sort of swapping them into other ones and hoping the one they bought goes up more than the one they swapped it out of. Whereas we can do proper spread-based lending between digital legacy assets and show the payable receivables. So a collateralized loan shows the transfer of the asset that was loaned, the transfer back of the asset that's held as collateral, and the payable receivables to show the obligations to each party to return them.
Okay, I'm going to
That's
pause
all right.
first. No, I love what you're saying. I'm going to just pause you for a second because one of the thoughts that while you're talking is how you now have this structured also sounds as if the speed of the transactions will be fairly quick.
Yeah.
And which is important because if you have a point of sale situation and it takes a while for a transaction to go through, then that slows up the process of the exchange. So how with your protocol, how does that work?
Well, so I was explaining the process. The way of controlling the systems today, most of them are virtual middles, and it takes
Yes,
time and it takes
right.
things. We've pushed the control to the edge. So effectively, if an asset lot is controlled in one place but distributed to another, you can't double spend it because if you spend it here, think about it, if you've got a debit card, you've got a balance. If you swipe and use your balance, you go to swipe it again, you get refused. That's because you've got accounting and
Yes.
you've got an asset lot that you can control. If the asset lot is only controlled in one part of the network and not just in this virtual middle, then you've pushed the process and the controls to the edge. So that means our transactions are effectively real time. And this is critical because in order to get to real-time settlement, at the moment, you own Bitcoin, I have it, you give it to me. If I have money, the reason money works is because I've got it and
Right,
I give it to you.
right, in that moment.
In the financial world, the banks don't have your money. They take your money and they lend it out.
Yeah, so
So
that's
every
right.
day they're getting their credits and debits and working out how much they need to borrow or lend, all right?
Right, right.
That can, because some of the processes of settlement are 1 or 2 days later, they can book everything today and then work out what they have to finance the next day. And they're just playing catch up with that. But that's okay. But that's the latency, that's the inefficiency that's in the financial services. To actually be able to borrow and lend intraday, you cannot have an arbitrary settlement. You can't say, hey, let me borrow this from you. Okay, well, depending on the protocol and the volume, it may settle in 5 seconds, 5 minutes, or maybe 5 hours. I don't know. Then everyone's going to just say, let's just settle at the end of the day like we do today. Because the depositories and clearinghouses allow the institutions to run imbalances right up until the end of settlement. And so unless you've got real-time settlement, you actually can't do intraday real-time settlement, intraday financing. And intraday financing would be, and with two big institutions, I borrowed this from you, I paid you that, I lent this, we did that. Every so often, we can recapture the payable receivables, net them, and settle them when we need to, either based on a monetary amount or a timing, but we're tracking the whole thing. But if the settlements of those obligations, if you can't record obligations and the real settlements are arbitrary, you're living in chaos and you can't predict anything. So that's what we built our protocol so that everybody's obligations can be known and everybody's settlements can be known. And again, it's bilateral. So while the network, you think of it as a stock exchange ticker, all you're seeing is this asset went that way, this asset went that way, this asset went that way, this asset went that way. That's what ours look like in terms of the synchronization. It's only the users that know their own assets and see their own positions.
That's amazing. So who are the clients that you are thinking will, I mean, I can think of many, but who are the clients that you are thinking will want this?
Initially, we're aiming for people with natural communities because obviously you need to have the critical mass. So we've talked to legacy exchanges as a proof of concepts, and we've got digital exchanges interested because at the moment they execute trades and then it's gone. Then the settlement happens somewhere else. This is a way for them to offer that as an expansion of their product. the clearinghouses themselves are at risk, but that's why you've got many of them, embracing this technology because they want to still facilitate the settlement, even though it may be on a distributed ledger. So we talk to those. In the supply chain world, we're talking to software companies that have clients that have a natural network, and the big banks, the big global banks, are talking to us because as much as they transact with each other, they also transact between their legal entities, or they have products or records. And you're dealing with big funds. You have, the fund manager runs an investment book of record. The custodian runs what they call the custodian book of record, and then you've got the accounting book of record. Those three things are generated independently and reconciled back to each other, which is a nightmarish process when you've especially got a global portfolio, huge investments, money's flying, or there were dividends and corporate actions and everything flying in. So now imagine if one was updated and it shared it to the others. Mm-hmm. So there's a lot of exception processing in the institutional finance industry, mainly because of the friction and delays in settlement. The idea that you can resolve those issues at the front door and prevent them from happening in the first place, and mainly through shared data. You don't eliminate reconciliation completely, but you can reduce the number of reconciliations, and everyone becomes synchronized. If you think about it, the world's been trading in real time, off real-time data for decades. But everything about settlements is happening 1-2 days later,
right?
And that's where all the errors and potential fraud can occur, and it's more errors than fraud, thankfully. But it's just that things go wrong and people are playing catch up. And remember, although you as a retail client tend to see the correct balances, there's very few errors in retail. It's really showing you a balance that still has to be aggregated, financed, and positioned, and that's where the institutional guys can have errors and in the background. But that's what there's. Just another thing you can say is that we've got new opportunities. The U.S. equity market does about $300 billion in trades every day. Now, the big guys trade with each other, so they net down to about $30 billion in settlements that have to be, that's actually people now delivering real positions versus money. But because they settle 2 days later in the US market, each of the brokers posting collectively $8 billion in settlement risk collateral. Now, that's $8 billion on their balance sheet. So, and that's a huge cost. And the fund managers who are buying from those brokers have that counterparty risk until it's all settled. So imagine if it was happening in real time. There's $8 billion goes back in terms of balance sheet to the brokers, and the fund managers no longer have counterparty risk. And then you can trade on margin, meaning you can borrow money to trade. Well, your limit is how much multiples you can borrow. Can I borrow 2 to 1, 6 to 1 of what my principal is? But your also limitation is your outstanding trades. If your outstanding trades hit that ratio, you cannot trade anymore because you would increase your leverage. Well, with real-time settlement, there's no outstanding settlements except for that short period where you're netting. So now you've got much greater turnover. So the hedge fund community, the trading community would be interested because they can literally turn these portfolios over as quick as they want to because they'll be settling in the background as quick as they trade. Now, volume means more liquidity, more price transparency. So we believe if we get this to this more efficient market, it actually has a dynamic effect on the front office as much as it provides the reduced risk and cost in the back office.
It's fascinating to me just because I like to see how technology can solve problems, mm-hmm. and the evolution of the technology, and it's like you said, when blockchain first started and the fintech world first started, it was they probably didn't think that this was going to take hold as globally as it has. And so as it has grown, then the need for the solution that you're talking about comes to bear, because the future of this means that we're going to have to solve this problem in order to have more people involved.
Yeah. Well, there's two sides to what you just said there. I think the crypto DeFi world, although they have a lot of their problems, crypto, will it have a utility in payments? DeFi, are they stable? Are they safe? We've seen a lot of headlines around because it's open source, because it's vulnerable, and there's certain issues around security that fiduciary or regulated institutions are going to have trouble with. But what they've shown is that these global networks can work. right? Now, if we can get an institutional solution that does that, then we can bring the regulated fiduciary worlds. Because most of us, as much as you talk, Bitcoin maximalists want you to log on and be your own owner of the ledger and everything else. Well, you don't go to the internet, set up your own server, get your euro, you go through an internet hosting service. So we believe the nodes will be transacting hosting services, and you'll go, but with the right protocol, you can now transact more easily. The key thing though, and you're talking about solutions, similar to the way emerging markets could go to mobile phones without copper wire infrastructure.
Yeah.
Distributed ledgers blockchain allow you to create transacting ecosystems without necessarily having had an institutional clearinghouse to start with. In fact, it's almost a hindrance because you've got to transition away from it. So the big solution is to really make low-cost fractional transactions accessible to a community. As long as you've got the regulated institutions to set up the nodes, and they can run it on behalf of their constituents. Some of the bigger use cases we're looking at in other countries are around, capital markets, infrastructure for emerging markets, or even, huge supply chain, logistics, where they're looking to, they can suddenly, the internet made connection and communication consistent and accessible. And because it was consistent, it became ubiquitous. Now imagine transacting protocols. So whatever you're transacting, you're using the same formats, and you can link to different networks and move. That's the real potential of this technology.
Very much so, very much so. Let's talk for a few minutes about GBA. Oh, what's your
Okay.
involvement with it? And I'm loving everything that we're talking about, and it's all connected because GBA is all about education and having people be able to network
Yeah.
and use the products and services. But tell me a little bit more about how you're involved with GBA.
Well, yeah. When I was, well, I still am to some extent. When I'm starving venture, startup, you're looking for anything that's free, or informational. And I'm sure it's about 4 or 5 years ago. Gerard had set up the GBA. He came to New York, and did a presentation with some members of New York State government, other IBM, other people that were there, and more or less said, I know governments are horrendously inefficient to deal with, and horrendously slow to adopt new technology. So I'd like to solve those two problems. I thought, well, this is something I can get behind. So I watched from the sidelines, but then they started doing some of their big events, and they did a event at the Congressional Auditorium, and it was 450 people, and there's all these different solutions out there. I got to meet Scott Stornetta, and he's actually, we're in regular communication now. Scott Stornetta and Stuart Haber invented the first blockchain in 1991, and it's their articles that are cited in the famous Bitcoin white paper in 2008. So I then became more active. So there's different working groups. I was involved in the banking finance group just to watch it because I'm interested in the party. I joined the voting group. Although I'm personally an active voter, I'm not an expert on elections, but I joined it to learn.
Yeah.
And then there's an identity management group. There's other groups, and then I got involved with the events. And Gerard asked me to speak. I've subsequently become the head of the banking and finance working group. What I like about it, for me personally, is I'm happy to contribute and share my ideas and thoughts around it, because you think you're in competition with a lot of these people, and there's a lot of use cases. While there's a disparation or difference between public and private blockchains, they're complementary. They're solving two different issues. And even in the private blockchain space, there's certain that are geared to healthcare. There's certain that's geared, and there's ways that we can see to learn, because what we're trying to do is promote the solution, but we're also drawing attention to the limitations. And one of the big things we've done recently, it was a standards and certifications group. We created the blockchain maturity model, which now allows buyers and sellers of blockchain solutions to, assess themselves on 5 layers of sort of preparedness against 11 different elements. And then what I've also been involved with is I guess, within the banking financing group, we developed a supplement, because there's certain things around banking that are unique to it. And Gerard brings up, like with voting, if you have a voting use case, there should never be a connection between the voter and their vote, but the voters should be able to check their vote, right? So that's a kind of confidentiality issue. Whereas bankers have to know their client, although they don't necessarily want to share the client data in the network. So there's different logistical issues with each use cases. So we've got supplements going on with the banking finance, the working group, the healthcare group. I'm not part of that group, but that's developing their own supplemental standards. And it's again helping the industry uh, really sort of say what's the best solution and how do I use this technology while we're all sharing and refining. And I can't really talk to many of the other industry forums, but there is a great sense of community and collaboration. I mean, Gerard's just I think Gerard's tagline is connect, communicate, collaborate, or whatever. But it's there is, you're able to help each other, and we've done a lot of work pro bono. But I've made some great connections, and some of our opportunities have come from people I've met at the GBA event. So I think if you go in saying, "How can I get business?" you're approaching it wrong. If you go in saying, "How can I learn? How can I contribute?"
Exactly. Exactly.
then it kind of reflects back, and that's the nature of the people I've seen involved, and so and it, like anything, even as something as simple as a podcast, it becomes marketing material, it becomes something. I find there's very few certainties in the world, so you want to be testing your ideas, you want to be challenging things, you want to be communicating with people and seeing what the pushback is, what the affirmation of a good idea and the control of a bad one, and that's what I've seen. So it's been I've enjoyed participating and contributing, and especially now, funny enough, there's a new event coming up in May called the Future Governance of Money and Law, and with everything that's happening in like FTX and the crypto world, the DeFi and the exchanges, people are sort of saying, "Whoa, hold on a second, what's going on with this technology?" And as much as they want to, improve the current traditional finance, they don't want it to destabilize or fall over. So, and obviously the regulators are all over us, so we've got to be, keeping them. But we can have an influence on that. That's the other good thing with the GBA. There's participation from congressional staffers. There's participation from influential academics. And I'm always amazed at we had a White House advisor speak at the last event. You've got real, I found just to hear some of these people, a lot of these conferences are like, it's sort of like hype preaching to the choir, and you're hearing stuff that you kind of already know. With GBA, I always find there's 5 or 6 different things that I'm learning, and I'm not just saying that for motion's sake. I'm saying that's, and you get your money's worth. You're gonna learn, you're gonna hear a different perspective, and you're gonna meet a lot of different people. That's what I've enjoyed and got out of it.
Yeah, no, I agree with you. I feel like a sponge when I go to the events. And for everyone who's listening, I will definitely have embedded within the blog the contact information for GBA, as well as I'll always update, event information, because they do have a lot of different events that are going on. And as you mentioned, a major event this May. So there'll be contact information in the blog. So that way whoever's listening can register and attend and also participate. The networking, and also, like you said, the communication between people. Everyone who I've met is so brilliant, and it's just it's amazing the conversations that happen. And even the openness, like for my questions when I don't know something, and it's like everyone is willing to bring the next person along, which I think is really important, because someone might come up with an idea that then is needed, and you never know where that inspiration is going to come from.
Yeah, no, today I was, last event, there was an interesting presentation on the grants that are available for the National Science Foundation, and we took a look at it, and we're considering an application ourselves, but you've got to be in certain use cases and specific, and we're not sure if we're too far along advanced, rather than research. But there was somebody else in a meeting today who I thought, you're a suitable candidate. So I sent a man notes and said, look, we we worked this out. We think this is the way you would apply for it. We're considering it ourselves, but you may want to take a look at this. It's one of those things where, to find that information on your own is a huge search. So, it takes away. That's again, through the events, through the working groups, you start to, you get there's a lot of tentacles out there as far as information and helpful advice.
Yeah, for sure. Well, I really appreciate your being on. We're going to have more than one episode. So everyone who's listening, Paul's going to be on throughout the year because there's things that we want to talk about, current events and things like that. So definitely like and subscribe so you can kind of stay tuned. And, again, for those that are listening, if you have questions that you want answered, also, email me so I can, reach out, whether it's to Paul or someone else within the group that might have that information. So, Paul, any last minute thoughts before we sign off?
No, thank you. This is a fantastic conversation. Really enjoyed it. And again, I would say the same. If people genuinely want something, please find me on LinkedIn. Don't send me a cold call DM. That's what's going on. I've got all the developers I need. I've got all the marketing I need. I've got no. It's like if I had a penny for every one of those DMs, I'd be rich. So that was good.
For sure. So remember, everyone, what I always say at the end of all my broadcasts is be kind to yourself, be kind to others. We're all so interconnected and we're all part of one world. So have a great day. Thanks so much.